All right, today we are diving into one of the most unbelievable stories from the 2008 financial crisis, the AIG bailout. Seriously, this is the story of how one single company literally almost broke the entire global economy.
Just look at that number for a second. $182 billion. That's how much the U.S. government had to pony up to save one company from going under. It is still the biggest government bailout of a private company in history. Just wild.
And this, right here, is the central mystery. I mean, when you think of insurance companies, you think of something safe, stable, maybe even a little boring, let's be honest. So how on earth did a global insurance giant like AIG get into so much trouble that it needed a rescue package this massive? Okay, let's get into it.
To really understand what happened, we've got to go back in time, back to the absolute chaos of September 2008.
You have to picture the scene. The feeling in the air was just pure panic. Major banks were failing, money markets were completely frozen solid, and it seriously felt like the entire financial world as we knew it was about to just shatter.
And as everyone was scrambling to plug the holes in the sinking ship, they realized the biggest threat, the one domino that could knock everything else down, wasn't a bank. It was an insurance company, American International Group. You know it as AIG.
So, why AIG? How did an insurance company become ground zero for the meltdown? Well, it all comes down to a really complex financial product that AIG had secretly turned into a massive, unregulated casino. And it all started with what looked like a sure thing.
This thing is called a credit default swap, or CDS for short. Now, the simplest way to think about it is just as an insurance policy on a loan. So, say a bank lends out a bunch of money. They might go to AIG and buy a CDS to protect themselves. If the people they loaned money to can't pay it back, boom, AIG steps in and pays the bank. Seems simple enough, right?
Now, for years, this small, super profitable AIG office in London, called AIG Financial Products, was selling these swaps like hotcakes. We are talking billions and billions of dollars worth. And it felt like free money, because for a long time, defaults were super rare. It was just pure profit rolling in.
Okay, and this is the fatal flaw. This is where it all goes wrong. On the left, you've got normal insurance. It's heavily regulated. You have to keep a big pile of cash on hand in case you need to pay out claims. But on the right, you have AIG's swaps. AIG brilliantly and catastrophically argued that these swaps weren't technically insurance. So they didn't have to follow the rules. They operated in this regulatory blind spot, which meant they held zero, and I mean zero, cash in reserve for potential claims.
And the scale of this bet, it's just staggering. AIG had written these insurance policies on over $500 billion of debt, a 5 with 11 zeros. And most of it was tied to the U.S. housing market, which everyone assumed was rock solid. They had built a financial house of cards that was unimaginably huge.
And you know what happens to a house of cards? In 2008, it all came crashing down. Those safe bets became toxic, and it happened with incredible speed.
You can see on this timeline just how fast everything fell apart. For years, AIG is just printing money on these things. Then 2007 hits, and the housing market starts to crack. That leads right into early 2008, when homeowners started defaulting, and suddenly AIG is staring at massive losses. By September, it was game over. The banks that bought all that insurance from AIG got spooked and demanded their money. They said, hey, prove you can pay us if things get worse. We need billions in cash collateral right now. And AIG, well, they opened the corporate wallet and there was nothing inside.
So that's the bottom line. AIG had collected all these payments for years, ensuring incredibly risky debt without setting aside a single penny for a rainy day. And when the hurricane hit, they were completely wiped out. They were insolvent.
So this takes us back to the government's perspective in September of 2008. They're looking at this collapsing giant, and they're facing an absolutely impossible choice, with the entire global economy hanging by a thread.
Just one day before AIG hit the wall, the government had made the decision to let another huge firm, Lehman Brothers, go bankrupt. The result was immediate, worldwide panic. But they decided AIG was different. AIG's failure wouldn't just be one company going down. It would trigger a catastrophic chain reaction, taking down major banks all over the world that were depending on AIG's insurance. AIG was, as they said, too interconnected to fail.
So the government had to act, and they had to act fast. Here's the emergency plan they came up with. First, the Federal Reserve pumped in huge emergency loans just to stop the immediate bleeding.
Second, the government took an almost 80% ownership stake in the company. Yeah, they basically nationalized AIG. And third, AIG was forced to start a giant garage sale, selling off its best, most valuable assets to start paying the taxpayers back.
And here's the thing. The rescue worked. It prevented a complete and total meltdown of the financial system. But the story doesn't end there. The long-term fallout, the anger, and the debates over that decision are still raging today.
So what was the final result? Well, on the plus side, AIG did eventually pay back every single dollar, plus interest. The government actually made a profit. The crisis also led to new regulations, the Dodd-Frank Act, to try and stop this from happening again. But, and this is a huge but, the public was absolutely furious, and it raised this really critical question of moral hazard. Think about it. If you run a giant company and you know the government will bail you out no matter how risky your bets are, what's to stop you from gambling? If you win, you keep the profits. If you lose, the taxpayer picks up the tab. And this quote just sums up the whole dilemma perfectly. Yes, the intervention saved the global economy from a depression, but by doing it, they kicked off a firestorm about fairness and whether the system was rigged. They saved the game, but maybe they broke the rules in the process.
So that leaves us with this final, lingering question, which is really the most important legacy of this whole saga. In saving one company that was too big to fail, did we accidentally create a system where the biggest players are now permanently shielded from their own mistakes? It's a question the world is still trying to answer today.